Anand Tandon of Brics is with us now to talk about where we go from here. Anand, morning. Thanks for joining in. Are you expecting a repo hike today? And how much of an influence or how much of a directional guide will the policy be, you think, for the equity market today?
What consensus seems to indicate is that there will be an increase in CRR, and beyond that, there is, somewhat differing opinions on whether or not there will be a change in the repo, reverse repo, and so on. Broadly, I think, if one goes by consensus, it should not affect the market at all, because as many people have pointed out, there is more than adequate liquidity in the system. And, also the fact is that the RBI by itself is somewhat of a toothless tiger, because it is not so much the Indian markets, it's being determined by the RBI policy as by the international flows and what happens in the rest of the world. So, unfortunately, we've come back to the stage where we are watching Mr. Bernanke more closely than Mr. Subbarao.
Anand, morning. So, X of that event, how are you feeling about the market anyhow?
Well, obviously the markets had a good, reasonable correction right now, and therefore to some extent is somewhat oversold. I wouldn't put it past it to make an attempt to come back up again. But if you were to look at a slightly longer term picture, the way I look at it is you have to weigh the probabilities. So, interest rates, are they likely to move up from here or move down? Clearly move up. If not, stay where they are. Not good for the market. Primary issuances, are they likely to be large or small? Clearly they are likely to be large, not good for the secondary market. Foreign capital, it's likely to come back in or move out. They've had a rocking year in emerging markets for the most part. Most emerging markets have given 100% growth rates. Would you take money off the table or leave it on, especially in a possible tightening situation? I would imagine that the probability is in the favor of taking some money off. Domestic growth, is it likely to sustain at a higher level, or will it start to taper off? I would imagine that it's evenly divided at this stage, but I think, because the last year has surprised in terms of GDP growth, I would imagine this year would be a lot more difficult to surprise. Fiscal deficit, will it be an issue this year? On the balance, probably yes. Does that mean that the taxes have more probability of going up or coming down? I think clearly more probability of going up or down. You can do the maths. I can't think of anything which should take the market up big time from here.
Could it take it down big time, Anand, or do you think it just grinds in a bit of a range, spends time till the good news starts coming back? What's your base case scenario? A deep correction or just a range-bound market for several months?
Since we are in a market which is largely driven by excess liquidity, I would think that market movements are likely to be exaggerated. So while you may argue that the earnings growth will remain reasonably good and the GDP is not going to fall off a cliff, I would think that if at all there is going to be a reversion of flows into the market, and if there is a greater risk aversion vis-a-vis equities, I think the likelihood is that the correction can be quite sharp and painful before it starts to recover. Our best case scenario, I would think, is that barring aside unforeseen circumstances, you would end the year more or less where we started. And since it looks likely that the first half will be negative, it's possible that the second half will be better than the first. But I'd be surprised to see the market running away in a big way. How far down? Difficult call, because to some extent we are chasing our tail. It depends on what the next guy does more than the fundamentals. But, if you have to assume that the market was slightly overpriced in terms of the fundamentals itself, I would imagine a 15-20% correction should not be difficult to assume.
Significantly lower ahead of the budget event, you would say, Anand, or some of this correction might come after?
Depends on how we get into the budget. I think, if the current correction continues, yes, it can be, you probably have done most of the damage before the budget. If it doesn't continue, then it obviously will leave some space for the budget to create a problem. Again, in the budget itself, I don't think that there are too many levers that the government has, besides disinvestment. And I think the disinvestment is also causing the panic in the market, because if you're looking at 30,000 crores going out from the fresh supply coming into the primary market, obviously that puts pressure on the secondary. So aside from the technical factors, I think if you really, as I said, look at start worrying about the deficit, which in the case of India we have to, because all said and done, unlike the US, we don't have a situation where people are sanguine about putting money at 0% interest rates into government securities. Consequently, we have a situation where for the first time in many years, I think the last 4 or 5 years, there are foreign exchange reserves have not been increasing substantially over the last 4 or 5 months and now are actually less than 1 year's imports. It's not as scary as it sounds because obviously the deficit is much smaller. But that said, this is the first time in the last 5 years that the reserves have fallen to a level which is less than 1 year's. That's not good news. That can easily put pressure on the rupee if there was to be a reversal in investment flows. So overall, I don't think that the situation is such that the government has too much liberty. They have to find ways to cut back expenses, and that's not going to be exceedingly popular, and or raise taxes, which is even worse for the capital markets.
So that's Anand, how do you approach the interest rate sensitives now with so much focus about how much rates are going up, if at all?
Then I think it depends on the sector that one is talking about. You take capital goods, for example. Clearly, Larsen has spooked the market quite badly with a result which is less than exciting. Also, if you look at some of the other numbers that have come out, it clearly shows that at least in the power sector there has been a significant slowdown for the last quarter. Now, given that that was one of the darlings of the market and the expectation was that at least there is huge visibility of order book as well as earnings there, that's a little bit difficult to explain and therefore not necessarily a great sign for the market. I think that's one sector which is overweight in everybody's portfolio, where everybody is significantly long, and in a few cases at least you are sitting on lots of profits. So if there is a further downside, that can happen there. Same thing goes for public sector banks. Again, the banking results are not that exciting. Of course, to some extent it was understood because of the fact that NPA coverage levels had to be increased. But without the increase as well, we are looking at quite, not so great numbers. I mean, State Bank is a case in point. You have actually dropped the coverage ratio, and in spite of that, you are looking at a situation where they are warning for further NPAs going ahead because of the kind of aggressive growth that they've shown. Again, a sector that is over-owned and therefore likely to suffer in terms of any downside. Real estate to some extent is, I think, already come down quite a bit and therefore may not be that much of a sufferer, especially because private equity still seems to love it. And so long as you have capital flows coming in, they can probably hold out in terms of not selling but marking to market or marking to model their portfolio of holdings. So I think, broadly, if the market comes down, these are the sectors which have been the favorites going into the run and therefore may feel the heat a lot more. I think it has got less to do with the fact that it's an interest rate sensitive, more to the fact that they are just the ones that people are holding extra off.